Hello, everyone. I'm Karen Cho from CNBC, co-anchor of Squawk Box Europe. Thank you for joining us this afternoon as we explore what's driving the asset management industry today. As markets skip from record to record right through 2017, yields nudge higher from record lows, technology disrupts most industries, and geopolitics continues to prove unpredictable. We'll be discussing the rapidly changing financial landscape and how asset managers are thinking about the world today. The panelists will debate the topics first for about 50 minutes. We will then open up the conversation to questions from the floor. So have a think about some of the conversation talking points and pitch some of those questions towards the panel at the end. Let me introduce you to the panel. Joining us today, Greg Williamson, Chief Investment Officer of American Red Cross. Michael Freno, Head of Barings, Global Fixed Income and Multi-Asset Groups. Rick Lacaille, Executive Vice President and Global Chief Investment Officer at State Street Global Advisors. And Michele Gesualdi, CIO at Kairos Investment Management. Gentlemen, thank you so much for joining us here today at Milken. I want to start with the discussion first up with a conversation on disruption. Now, as we know, technology is impacting every industry, and there's plenty of it to come yet for asset managers. However, the industry has been going through enormous disruption through the rise of passive investing. Well, first up, let's talk about that trend, Michael. If I can ask you, as we look to wrap up 2017, what do you make of the passive trend so far? And are we looking at a bit of a market bubble fueled by this change?
Well, I wouldn't want to use the word bubble with it, and maybe I'll certainly let Rick take an opposing view to this, but I'll speak to the side of things where I think active management still carries a lot of merit. Although, obviously, the AUM that Rick's responsible for speaks volumes that there is a part of the market that is going passive and that has done quite well. But I would argue there's also areas of the market that are where managers can still provide significant amounts of alpha. Certainly it's in parts of the developing markets, both on the equity and the debt side. And below investment grade credit, I think that's, and maybe credit in general, you're still seeing that. And then certainly as you get to things that are maybe a little bit less liquid, those are areas that I think are still somewhat immune, at least at the time now, to passive investing. Although data and technology will certainly change that. But I do think that there still remains a spot for that within the world that we invest in, and active managers are going to have to continue to provide alpha to justify that. And in areas where they don't, I think the market will go more towards the way of passives.
Rick, let's get you to weigh in because there are growing warnings that passives have become too dominant. Here's one figure. 90% of daily equity flows in the States are passive. That's including leverage and turnover, not assets under management, which the industry cites. So is there going to be a cascade effect when the selling finally hits?
Well, I'd take issue with the fact there's too much passive or we're teeing ourselves up for challenges. Again, turning to the clients need what passive is able, or indexing is able to provide, but most clients actually need more. So although capital markets can provide much, and indexing is a very efficient way of getting those exposures, most clients need more. I think what's changing for active isn't necessarily the threat of indexing, it's that technology and techniques are eating into some of the things that hitherto had been the mainstream of active management. And I think that's an equally big challenge to the simple challenge of indexing.
Michele, weigh in.
Well, I mean, my view is that this is a sort of disruption that is happening in the asset management business simply because we are trying to replace, passives are basically replacing all the substandard active managers effectively. So I don't see anything, even when I look at it from the alternative point of view, it's frankly a process which is, from our standpoint, quite good because it means that a lot of active managers which are substandard will get out of the market.
Is it just these active managers who are substandard, though? Because there is a feeling with so much herding, it's creating inefficiencies in the market and sort of pushing up asset values in certain quarters of the market. That's not just against some of the substandard asset managers.
Well, but in a way, you get obviously more passive flows. That means that it's more predictable in the way that it gets invested. And therefore, if you are, for example, an alternative asset manager, you can exploit these inefficiencies because the inefficiencies will be greater with more passive investment. So in a way, I think that there will be a polarization of the industry where you get more passive investments and also more alternatives. If you combine the two, they're roughly 25% of the assets globally, and they can go and they can grow to maybe 50% where you get a blend of passives and alternatives.
Let's hear from Greg.
Yeah,
Does this
Karen
make the world easier?
No, well, as an asset allocator, let me suggest that the passive investment phenomenon is more a reflection of what's going on in the market. It's not a driver of the market. It's really a reflection of the fact that central banks have been inflating the economy for the last 7 years. Beta has become very cheap, and I can get a decent return with a cheap beta by investing passively as opposed to investing actively. This happens on a cyclical basis on a regular period. So really what the move to passive is reflecting is the reinflation of the economy by the central banks. When that ends, you'll see a much more focused approach by investors in looking for the dispersion opportunities in the market or a move to active investing.
Will we see an orderly move south, though? I mean, there's been a few sessions in the last few weeks, some around high yield. There's been a bit of a high yield wobble. If you look around technology, just in the last couple of weeks, there's been a fairly aggressive sell-off intraday. So the question comes up, will you see orderly selling when it takes place?
Has there ever been orderly selling? I don't think you will. Actually, I don't think we're done with our move anytime soon. I probably, different than Rick, we're much more positive on the market going forward, and we still believe that we're in a bull market. The central banks are still providing significant accommodation. $300 billion is being added to central banks' balance sheets every month, and that will continue to flow into financial assets for some period of time. We see positive growth continuing as well, and as long as those conditions hold, we'll see perhaps a little bit more volatility in the markets because the bull market is long in the tooth, but for the next year, 18 months, 2 years, we believe we'll continue to be in a bull market.
Yeah, I would agree, and I was a high yield guy by trade, so I always take offense when I hear of a wobble and I see all sorts of doom and gloom when high yield trades off half a point. But I think there'll certainly be some when things really do sell off, and I tend to agree with Greg that we're probably in an environment that's supportive of things continuing at this pace for a while, maybe not upwards, but certainly stabilizing here and with positive growth, and there'll be winners and losers. But when it does come out, then it's always volatile, and there's always inefficiencies there. And I think that's really where, if there is going to be a slowdown in market share gains by passive, it will be when the correction comes.
And you're standing ready to benefit from exploiting these inefficiencies, because there is a feeling that the passive investors have had their way for so long because of the type of market structure we've seen, yet there will be some big payday coming for the active managers. Is that coming soon?
I don't think it's soon. I mean, I think my view would be we've still got probably 12 months of very good, strong corporate fundamentals. But yes, I would say when it happens, and I think you've seen a little bit of sell-offs periodic or minor sell-offs, and folks have been ready to step in quite quickly. Things that would have been more dramatic have been waved off, and folks are stepping in to buy pretty aggressively. And I think that has a lot to do with where corporate fundamentals sit today.
I think I'd like to take issue with the idea that indexing is somehow a bull market phenomenon, and that we're all waiting for the end of a bull market when active management can kind of regain its credibility. I think right now is actually a pretty good time for active management. You've got cross-sectional dispersion of returns and dropping correlations. That means the playing field's actually fabulous. But if you look at what happened, for example, emerging market debt, you've had a number of years where active managers collectively, in a sense, have had a fabulous opportunity set. Again, dispersion's huge, but they've taken more risk than the index and underperformed. So the idea that somehow in a difficult market you're bailed out by active management needs to be challenged.
But it's also true that, I mean, you have had basically over the last 10 years a sort of 2 trillion rotation from value investing, active investing into passive and momentum. And almost by definition, a lot of the passive indices are momentum. So there is clearly less ability for people to take the other side. So when things fall, I mean, if you take 2008 or even before, there would be a lot of money able to actually bet on the fact that things would come back. Obviously now it's less because there's more passive investments, there is more autopilot selling effectively compared to before. And so that's clearly a risk if you get a downturn, which was not there maybe 10 years ago. Despite what happened, then it was not there.
Well, I simply put the point that indexing reflects the opportunity set. And in that sense, it's not a momentum trade. There certainly are momentum indices. But if you look at the index, it reflects the aggregation of investors' holdings, active investors. Some are overweight the FANGs, some are underweight the FANGs. Some are overweight biotech, some are underweight. But in aggregate, that is the market. And that's what indexing in its pure form is trying to achieve, simply to reflect the opportunity set that's accessed by active managers.
Let's talk a little bit more about the environment. We've got Brexit very firmly on the agenda this week. We thought we might have a deal, and here we are still waiting for some form of conclusion to negotiations. Tax reform over the weekend, the Senate passing its version of the bill. It still needs to be married with the House version. How did these events come into the sphere of investing, Greg?
As I said, I think that the environment is still very positive. With what we see happening in developed economies around the world, we see strong U.S. growth, we see strengthening ECB growth, we see positive growth in Japan, and we think that those are all positive.
What about the rate hikes, though, next year in 2018? We don't know what the outlook.
We don't know what the outcome will be, but quite frankly, I don't think there are going to be much rate hikes in the United States. Chairman Powell has already said that we'll see a rate hike at the end of this year, and then we'll see what happens next year. Given the shape of the yield curve in the United States, the Fed is not going to push the curve to flatten position. And if they had 3 rate hikes on top of 1 rate hike this year, we would see a flattened 2 to 30 and 10 to 30 yield curve, which would really destroy economic development in the United States. So it's not going to happen.
The one thing that concerns us about this, the landscape now, is I think you have a coordinated growth basically globally. The one thing that can disrupt that and maybe be contrary to Greg's point on a measured approach on the move up in rates is inflation. We haven't seen it. We don't see many things out there that would suggest it, but that's the one variable to me that does throw a wrench in a lot of this, because that would force central government's hands to do things much more aggressively than maybe they want to do, and then put a damper on some of the growth things that are going on right now. But it would be nice to see a handoff from the monetary policy side to the fiscal policy side and get some of these things done. Irrespective of what gets done in Washington with tax reform, I still think the U.S. economy is well positioned, especially absent any inflation indicators.
Let me pick up on those inflation points, and we've spoken a lot about that on this side of the globe in particular, about how you battle what has been a mystery for some policymakers. Neil Kashkari on Twitter was talking about this on the weekend, that he still believes in the Phillips curve, that it is still intact, but perhaps the Nauru is lower. But if you consider the change at the Fed, and everyone's so comfortable about the communication from the Fed, that it's well managing markets, but consider we do have Jerome Powell, a man who is not necessarily seen as a leader, even if he is a consensus candidate. He is the richest member of the Fed after a successful career in investment banking, but he is the first Fed chairman in 3 decades without a PhD in economics. There's 4 other seats vacant at the Fed. Diane Swonk of DS Economics says this is the largest potential regime change in the leadership of the Fed since 1936. So should we be concerned about how inflation materializes and how a new Fed even contemplates what to do with that?
We should be concerned about how inflation materializes, and I think its interaction with technology and globalization. So if there's one thing that's kept returns alive for equity investors and credit investors, it's this long-run globalization. We were very worried last year that global trade was slowing down. Now it's picked up. The Trump risk is still there in terms of what could happen, and that has a very strong link to inflation. But when you look around, the signs of wage inflation, which could crush earnings and would be a real problem for the equity market, are just not there. And I think on the Fed, I mean, on the new appointments, we've got another new appointment of Tom Barkin, actually, as president of the Richmond Fed. There is a change of guard. It's not an intelligence test. Judgment is clearly important in the Fed. And I think they're individuals who are, in a sense, a continuation trade. So I don't think we're expecting, Taylor rule or gold bug type activity from the Fed. We're expecting, data-driven Fed in a continuation of what we've seen before.
Yes.
I think it's also important to notice that aside from the communication angle, I mean, the real issue is that next year we will see a change in the dynamic of the liquidity function. So there will be less money put into the system by central banks globally. And this will be the biggest change. And I don't think a lot of people are ready for this sort of regime change, which is actually quite significant. If you look at all the money that has gone, it's basically 15 trillion going into asset classes globally. This will change, the flow will change, the levels will change, and so aside from the Bank of Japan, everyone else will try to remove some accommodation. So this will be a big change, I think, for capital markets in general.
I'll tell you what I also think the market's not ready for is return to political risk in Europe. And we were just talking about the spectre of Italian politics next year. Do you think there is any chance that in 2018 we're again talking about unstable politics in Europe?
I think it's less of a concern, frankly, for me, because I think Italy is the main concern. And actually, if you look at the new electoral law, it probably means that in the short term nothing will happen. I mean, it's sort of status quo. There will be more coalitions that will mean probably in Italy that the government will change very often, but nothing will get done essentially. So this is a very big problem for the future, but in the short term it's good news. So with Macron, and maybe the German side is probably more interesting than the Italian side, frankly. Right. But I don't think it will be a big theme. The big theme is probably going to be the US and China.
Well, perhaps we have a grand coalition again. Let's, before we move on, just open up the Brexit door, because it is a big market-moving week potentially around Brexit. And we do have changes to the way asset management is run, whether the UK remains in some form of a single market customs union, whether there are a change in rules. Does anyone want to weigh in on the implications of this when doing business globally and how this impacts portfolios?
I think the obstacles to Britain may not need to be insuperable. But one thing is perhaps very important, that's that Britain and the British asset management industry focuses on quality and cost. So it shouldn't be complacent about its place within Europe as the premier centre for asset management. There are many competing centres. We need to absolutely focus on quality and driving costs down. Now, clearly sterling helps. I mean, sterling having declined by 15% or so is pretty helpful. But I do think we need to question ourselves, us Brits, are we really doing as well as we should do? Are we really pushing ourselves hard enough to drive up quality for investors?
What's the view from the other side of the pond?
We're global, so we certainly have a presence here in London and are facing it as well. I think Rick's got most of the points covered there. That I do think from how you manage assets into Europe, there will certainly be some steps that have to be taken to do that, and whether it's setting up bases and moving investment professionals to certain areas who ultimately knows. I don't think it'll be that dramatic from that standpoint. But certainly I think there'll be opportunities from an investment standpoint, specifically in sterling assets. I think there will be volatility around that when things start to become more clear, and whether it's based on technicals or fear or actual fundamentals, I think will create some chances for opportunity that can be taken.
And on a growth basis, we're like the story that's coming about in the UK. We think that there will be an economic an agreement that allows the UK to continue to trade with Europe, but it would also allow it to free its trade restrictions and trade more effectively with the rest of the world. Combine that with a less regulated environment, we think that the UK move will be a very positive one, and also believe that there are value assets to be recognized and invested in here.
Let's push on and talk about a different topic, technology. It's advancing pretty quickly. Industry events are discussing the next wave of technology, artificial intelligence, blockchain, fintech, big data, the Internet of Things. How do you think disruption, first up, Michele, will have an impact on the industry as you see it?
Well, I think the first element is going to be helpful because at the end of the day, blockchain, for example, which is the topic that everyone is discussing because of Bitcoins, actually is going to be very beneficial to asset managers because it will improve the way that the back office and the middle office is actually handled and structured. And so this will help with the payments, will help with the transfers. So that will be very, very good for margins and for the efficiency of asset managers. On the other side, you obviously get the other extreme, which is technology used to manage money. And clearly there, I think that there is a big competitive advantage for the movers like WorldQuant or Renaissance or Two Sigma and so on. So we'll be very concentrated in some players, and everyone that tries to compete with these players will find it very tough. So in our view, at the end, if you are in the middle, like most asset managers, you will probably need to try to use technology as a tool that you use for managing assets and for finding inefficiencies and finding alpha, but retaining the discretionary element, which is the sort of human capital type element. I think that will be the way that we would look at it.
I do wonder whether the middle will get slaughtered in this change, because it does cost a lot of money to invest in research and development, to develop these algorithms, bring together all the big data and make sense of it, so at least you can have a trading strategy. Rick, do you think only the biggest survive in the next wave, almost the Amazon effect?
I think there's room for niche. I mean, sometimes the smaller players have the benefit of not having a legacy. I'm not now talking about asset management, but you know, we look at the big banks. I think if you dig deep, you probably find COBOL code still lurking in those banks. It's really hard to get technology to the current state and deal with the legacy. And I think that's really the opportunity for smaller asset managers. But in some respects, there is a need to invest, and that's unfamiliar. We're very used to investing in people. we're not so used to investing in capital equipment and having a kind of long horizon view, which you need to be transformational. So I don't think it's very easy at all for us to do that, but we absolutely have to do it. Otherwise, someone's going to do it for us.
It's a good point, isn't it? Just simple IT upgrades have been a major stumbling block in some asset managers, let alone talking about artificial intelligence.
Well, R&D budgets, it was something we never spoke about before, and over the last several years, we've had to deploy them, and I think you can look at artificial intelligence and you can take it to extremes and what it ultimately means, but even in today's state, the data is there, and it's how are you using it to aggregate and to make, if you're still using people and you're not 100% of a quant strategy, how are you using that to aggregate the data to make it more efficient for your people to make those decisions? It's happening real time. I think with the advent of quantum physics, which is something don't ask me another question on. I don't understand it at all, but it's there, and it will allow things to be done much quicker. But we're like everyone else facing that and trying to find a way to get more efficient. You've mentioned scale. I think managers are going to have to find a way to be more efficient in what they do to deliver their product.
It sounds like everyone's going to be doing the same thing. So when we talk about using AI to make decisions, this is computer learning. Doesn't the computer all learn in the same direction? And suddenly this is just another wave of passive investing?
No, it learns very differently, and it depends on the data set that it uses to train itself. I think the combination of big data, AI, crypto, and blockchain or hash graph is going to radically change our business in the next 5 to 10 years. And I don't think our industry is ready for it. From an investor's point of view, an investor has never had access to the positions that make up their portfolio and what drive risk and return. And with the combination of big data and a distributed ledger where they can get real-time information about the holdings in their portfolio, they'll actually finally become investors that understand what's driving risk and return and can build portfolios effectively. And then managers are going to be disintermediated. There are 4,200 traded stocks in the United States. There are 8,800 investment products, and there are 10,000 hedge funds. There are 116,000 commingled funds. They're all doing the same thing. At the margin, what we'll be able to do is eliminate the inefficiencies in the market and drive prices down for betas, factors, and then alpha, so that the investor can then concentrate on the thing that best meets its solution going forward. But that means that the investment management industry is going to change, that investors are going to need new technologies and advice to help them manage the portfolios, that custody is going to change. 5 years from now, your next custodian is much more likely to be Amazon Finance than it is State Street. Sorry, Rick. Consultants are going to be eliminated. Consultants that actually choose asset managers for plan sponsors or other investors are going to be eliminated. They still might have a role. They'll be a knowledge advisor, but they're not going to exist the same way that they exist now. Our industry is going to be much more efficient and effective.
So can I ask you about what this means for track record for asset managers? Because I was having a conversation with someone who's seeding startup hedge funds, and they said track record is not the dominant theme for them now. Does that mean with AI, track record is actually going to count because whoever's got the best algorithm is going to be the most successful in the marketplace year after year?
Well,
is that going to be
again,
the criteria?
No, it will still depend upon the nature of the individual, because the algorithm, although it will grow organically itself, it does have human input in terms of defining what the ultimate outcome will be, and again, the use of the data set that's incorporated. The biggest challenge to and driver of advancement of AI is going to be the application of big data and the data sets. There just haven't been enough data sets available historically to be able to utilize more deep learning, machine learning, than has been the case historically. So as different investors look at different data sets and different time periods for those data sets, they're going to get different outcomes for their algorithms. There is a question as to ultimately if you have that holistic machine learning, that everything comes down to one algorithm. The machines will all learn and come to the same point, but given the different data, they can't do that by definition.
One of the other side effects, I think, of all of this is that some investment managers are moving more towards illiquids, because clearly when you have to compete with technology or firms that use technology in a very aggressive way, then one of the solutions is to step aside, like one of the titles here of the conference. So some of the investment managers are stepping aside, moving into the liquid, and they're finding their niche, and there's less competition from technology. This is one of the biggest trends that we have seen over the last few years, and it's unlikely to change. And if you look at the pressure from technology in the liquid side, it's actually very limited. And there's also very little impact on fees. It's one of the areas where fees have not come down.
Is that just in a world where there's lots of free cash available, plenty of money sitting on the sidelines in the form of dry powder? And would you change your commentary in a few years' time if we had a much tighter monetary policy environment?
Well, I think obviously that has helped a lot in the capital raising of some of these structures. And actually valuations, if you look on the private side, are sometimes higher than on public markets because of all the money that has gone into illiquid. So pension funds have gone to increase basically their private equity exposure by 20% and decreasing public equities by 10%. So there's been a big shift. And I think people underestimate also that illiquidity can last for a very long time. There's still people trying to sell things that they bought 10 years ago, before the crisis. So people underestimate that in public markets you get liquidity crises, but they last very short period of time. In the liquid markets, they can last for 10 years.
So,
Perhaps, Karen, just to touch on AI and big data again. I mean, it's obvious to the audience, I'm sure, but there's quite a big difference between forecasting the weather and forecasting stock prices. So we can all get really good at forecasting the weather through big data and better machines. We can't all get good at forecasting stock prices. The very fact of doing it changes the game. And I think particularly with big data and machine learning, and this is from someone who's actually done it as opposed to talk about it or written books about it, figuring out what's already in the price is critical, because you can assemble a lot of data, particularly transaction data and satellite data on car parks, who's going to which restaurant, the apocryphal stories. But how much is in the price is going to determine whether you're actually going to make money. So this physics envy that sometimes percolates our industry does need to be thought through quite carefully.
first, we never know what's fully in the price, and when we say that we know what's in the price, we're defining what's driving valuations in the marketplace. The great thing about AI is it has no preconceived notion about what's driving price. So things that historically we would say discounted present value of future cash flows matter, might not matter to the AI algorithm.
So no irrational exuberance is what you're saying.
Exactly, exactly.
With
With regard to the private equity and private security, I think we're in a transitionary phase where we're going to move from what we've seen for the last 300 years, a market of public securities to a market of private securities. The amount of capital that's sitting on the sidelines waiting to be invested in the private markets is doing so because there are better returns in the private markets, not because there's not an opportunity in the public markets. But having said that, we have seen a reduction in the number of public securities available for investment and a reduction in the float of those securities available. The market is demanding private opportunities. And with crypto securities, you will be able to have both an opportunity to invest in private securities in a more liquid format than you've been able to invest historically. So looking forward, we think that, again, the use of the blockchain, the hash graph, and the crypto securities is going to create an investment opportunity where institutional investors and individuals will hold private securities just as they hold public securities. But again, it's going to create a new industry, and that industry is going to be those who provide the good housekeeping seal or the underwriter's lab approval on a private security as opposed to an S&P or a Moody's rating.
It's a good point that you make, and you've seen it particularly in technology. We keep asking the question when some of these technology giants are going to actually come to the market, and we've just not seen it. There's been a dearth of IPOs in the sector as a result of all this private capital sitting on the sidelines.
And even in the private sector, you're seeing a move away from 10 to 12-year funds to evergreen funds, where the investors just say, we would rather hold this company forever privately than take it public, and so we want our investors to invest with us for the long term, and we'll give them an opportunity to trade out every 4 or 5 years, so there's more liquidity than there would be in the traditional private equity, but the securities themselves are going to remain private forever.
I agree. I think we've definitely seen a shift into private assets all the way up and down the risk spectrum, whether it be from private equity, but the private placement corporate market's been around for forever. But even more so, even on securitizations, originated securitizations, which are unique opportunities for folks. It is to some extent, the asset managers are shifting to originating their own opportunities rather than being a taker from what has traditionally been a bank-led market. And that has to do with regulation. Certainly banks' balance sheets have changed that equation a little bit. But to Greg's point, I do think that there is definitely an appetite for higher spread, higher yielding, illiquid assets that is going to be around for the foreseeable future. I can't see it shifting anytime soon.
Do you think that's a challenge or an opportunity at this point?
what's an opportunity for some. I think certainly where we think the opportunity is, again, is to be an originator, a self-originator. So you do have, if you're quality at what you do have the ability to underwrite those to your standards. You're not necessarily a taker, and certainly we can look at the old CDOs that went through the crisis. A lot of those were pushed into a pool, not underwritten on an individual basis. If you're originating those mortgages and then you're securitizing them and you're owning some of that risk yourself, that changes the dynamic dramatically. And if they're unique assets, then I think there's a premium to be paid in the market, notwithstanding, Greg, his enthusiasm for fee compression was a little bit high, a little bit more than I'd like it to be. But I think that definitely asset managers will have to differentiate themselves from alpha by generating alpha, and then maybe actually what securities are investing in.
Don't worry, that part is coming on fees. We're yet to get up to that. But just a quick word on the disappearance of some public companies from the market that just not materializing now, which means if you're a private investor, you have the opportunities that the public investor doesn't have, and the mandates, do they need to change? Do governments need to also change their view on how pensions?
Well, you can own the same company and pay higher fees to own it, if that's what you mean. Yeah, I mean, if you own it in your private portfolio, you'll pay 2% and give away some of the upside. If you own it in your index fund, you'll pay 2 basis points. So the $64,000 question is, does ownership of that company somehow confer a magic that drives earnings per share, return on equity to a level that justifies that difference in fees? I think there are many reasons why people don't want to go public, and maybe public equity markets need to retool in order to understand how they can address the gap. I don't think it's healthy that we drive everything into an area of the universe that is got many of the features of private markets. I do think they serve an important purpose, though, and there are times when companies need to be private in order that they can retool and do whatever they need to do. I think the future state's going to be more of a continuum between private and public, particularly as you see private securities changing hands and valuations and more price discovery happening in private markets.
Michele?
Well, absolutely. I mean, I tend to agree. Finally, I tend to agree with you. I mean, clearly, I think it's. I mean, the combination of passive and privates is actually a sort of good combination for people, because you can have the sort of beta side covered very well and very efficiently. But then, whenever you want to add alpha, you can have the private side or the alternative side in general be the source of alpha. Clearly, the proportion will depend on the inclination of the different investors, but that's the way that things are going. It's the people in the middle, which unfortunately are the vast majority of the asset managers, which will struggle, obviously, to understand if they have to follow the passive route, which is very difficult at this point, because there is a few limited players, or go to the more illiquid and the more alpha generative side, which is as difficult because you need the human capital and the people.
I think the opportunity for people in the middle is still enormous, because, sorry, we took about 2 minutes and we can disagree. Because, I mean, right now, tactically, the opportunity set is very significant in terms of cross-sectional dispersion of returns, lower correlation. The cost of acquiring information is dropping dramatically, so the production costs must be getting lower. I mean, whether that's passed on to the clients is another question. But I think there is a scale argument about asset management, but capacity is very, very scarce. When I think about the strategies that work best for us, we cap them very aggressively to stop leakage of alpha. So I think there is equally a sweet spot at this lower middle end that people can exploit. They just need to get on with it. They need to take more risk, get better information, use technology, lower their research costs, and then I think it's a viable and thriving world.
They become producers of alpha. I think there's a lot of in the middle. Probably the best way to capture that opportunity is to look at solutions. So in other words, how you blend the different pockets and the alpha and the beta and the risk premium. That is a big market. So that will be the other big growth. I mean, it's been already growing, but it will continue to grow because you need people to package the portfolios and do the asset allocation, which is also a big source of opportunity.
Well, let's get on to that topic, because I think we've already opened the door around smart beta and factor investing. How important are these elements for you first up, Greg?
Critical. We finally have transitioned from a world where we talked about factors to actually being able to implement them. You can go back to the original Markowitz work in the 50s, where he started talking about factors, and maybe Bar Rosenberg in the late 70s, and the introduction of BARA in the 80s allowed investors to more systematically identify factors in their portfolio. The problem was those factors weren't investable. So we could assess what certain exposures were, but we couldn't invest in them. What we've seen is financial engineering, which allows us to invest in factors now. The benefit of factors is that factors are the things that actually drive asset prices. So before I invested in an asset class and I accepted the combination of factors that existed. Now I can pick the factors that might best meet my needs and objectives. As we talk about solutions, I'm not just looking for some mean variance, I want to own the market type solution. I want a solution that reflects my ability and desire to fund my operations, or that really takes into account the distribution of risks that I need to accept. There are certain risks that I cannot accept. It puts my ability to operate at risk. And so I need to build a portfolio of risk and return drivers and distribution impacts that allow me to meet my objective. The nice thing about factors is that they're not market-based, they're really options-based. So if I think of momentum strategies, momentum looks like a long equity market in positive equity market returns, and it looks like a short equity market in down equity markets. It's only at the transition period that it doesn't work very well. Value looks like a call option on the equity market. So I can build optionality into my portfolios by using factors. It also allows me to assess whether the strategies that I'm buying are truly active or just a combination of passive factors that I can purchase through the marketplace myself. Now, historically, if I wanted factor exposure, I created them synthetically, I paid a lot of money for them, or I bought them incompletely. Now I can buy any factor that I want with daily liquidity in the swap market for 10 basis points. It really focuses the active manager community to determine whether they're truly adding alpha or they're selling expensive factors. But it more importantly allows me as an investor to create a truly customized and cheap and liquid and transparent approach to creating this distribution management problem, which I haven't been able to manage effectively in the past.
And I don't know if you were speaking this, and we're certainly no experts on the smart beta space, but where I see the next evolution of this going is more of a dynamic smart beta, if you will, and one that's more flexible in nature, and call it an active passive, where your alpha generation is through the dynamic allocation of things from a top-down basis, and you're picking your factors and moving accordingly with someone who has the expertise to do that. More relevant maybe to what we're doing now on the solution side is maybe not doing it through index or ETFs, but certainly meeting the demands of what folks have from a liability standpoint. Everyone's got some level of liability. It's more acute in certain industries, but packaging things together and finding a way, and I tend to look at things rather simplistically, that investors have three buckets. They've got an equity risk and return bucket, a below investment grade risk and return bucket, and a high grade risk and return bucket, and maybe some variations amongst those. But a lot of conversations have been around, how do we optimize that? Do you not need 100% of the returns of equities, but you can get some with lower vol and therefore a higher information ratio? And I think that's more and more dynamic coming into play. But it does mean adding sometimes liquids and illiquids together, and how do they correlate with one another? How do they react with one another? But that has definitely been, certainly I would agree with the comments earlier, that is a growth area in the market.
I just wanted to say something on the risk premia products, which, I share obviously your view. It's a very efficient way to construct portfolios. What scares me is that people forget that a lot of these risk premia are actually negative skew type risk premia. In other words, they tend to go up slowly and very frequently, but when they have down periods or down days, they can be raising a lot of the P&L. And so I think they are for very sophisticated investors. They should be adopted by sophisticated investors like yourselves, but not necessarily by the wider public, because it's quite risky and people forget, obviously, that there is this negative skew which can be quite harmful. And actually, if you look at the people that have now been selling a lot of the risk premia, a lot of them are the banks, which used to have basically the same people selling structured products. So it's financial engineering, it's very nice, and it works in some cases, but in other cases it's a bit abused, and I find it like giving the tools for an operation to anyone. Mm-hmm. Probably the doctors should do it and should use these tools, but not everyone. And that's my feeling.
Maybe there's a very interesting point made about buckets. And maybe for the first time after 40 years of effort, the asset management industry's figured out that actually the purpose of investment is not an end in itself. It's to feed some end goal, meeting the needs of a charity or retirement. And that then gives you other buckets. So there's the bucket that gives me enough money not to starve. There's the bucket that gives me enough money to buy a few opera tickets and a few other things, those kind of aspirational buckets, liability, goal-driven investment. But then you've got to say there's different states of the world. So when I retire, is the world going to be massively polluted, riots on the streets, climate change has caused havoc? Or when I retire, is it going to be a little bit more of a beneficial outcome? So from a utility perspective, return and risk may not describe all the outcomes, and I guess that's the reason why a number of investors focus on some of these long-term ESG themes, because what we do as investors in the way that we engage with companies actually impacts the long-run outcome, not just the risk and return liability matching, but the long-run impact.
So on that note, how do you sell smart beta to the world? I mean, Asia has been a growing area, China in particular. If you look at assets under management, not just on the value of those assets, but on actual net new money coming into the system, how do you sell smart beta to China?
Well, China's no different to anywhere else. I mean, it's a quality versus cost question. Can you squeeze more out of what has been an index fund, squeeze it a bit harder for very little incremental cost to get a better outcome? Or can you say you've got 10 active managers, in the aggregate they're providing you factor exposures plus a little bit of alpha. Maybe you want to have 5, but have them much more active, higher active share, and substitute the rest for a much lower cost outcome or a much lower cost product.
Is targeting Asia, targeting China, any different when it comes to asset management?
I'll go ahead with this. I think the challenge is going to be to have investment professionals present in the region, and certainly a lot of folks have it in Hong Kong, but moving on to mainland to invest, we'll call it the local to local market for local Chinese nationals buying local Chinese product, bonds and loans. And as that regulatory environment shifts, I think you'll see more and more of the larger folks move into that. But I agree that I think over time their appetites and their views of things will ultimately evolve to where we are. I think there is a demand right now, though, to be investing in their domestic markets by maybe a global firm.
Karen, I think there's a difference. There's a difference between an institutional investment in China, of course, the retail investment side. The retail investment market is not as developed as we would see in the rest of the developed world. On the other hand, the institutional side is as sophisticated as any other very sophisticated investor around the world. We meet with our Chinese counterparts in the sovereign wealth funds on a regular basis, and they are at the leading edge of portfolio construction, risk management, the adoption of AI and big data, and optionality in portfolio construction. They are as sophisticated as anyone else, and probably more sophisticated in the private equity investment arenas around the world, because that's where they see both an opportunity to get strong relationships that can help with their own internal growth, but also best ideas to help their assets grow over the longer term.
I can't help but think that listening to Michele for just even a couple of minutes, regulators might be suitably concerned. And we've already seen in recent times that regulators in China are trying to reduce leverage. So do you see them stepping in at some point, Michele, to some of these more sophisticated products that are now circling the globe?
Well, they have already stepped in quite aggressively to stop the wealth management products. They've been actually very successful in doing that, and been also successful because they haven't caused a financial crisis or any sort of hiccup. I think they've been managing their economy and their financial markets very well, despite of what is the opinion in the West, but actually they've done a very good job, and they will probably continue in that direction. I don't see any discontinuity in the way they do things. I have to say, one of the reasons why we are quite positive on the area is also the fact that if you look at technology, which we discussed before, I mean, they are probably as advanced as the US, if not more. If you look at the first examples of technology companies accessing asset managers and trying to do something in the asset management world, Tencent has been the first one to do it. The money market product, which was huge. They used their distribution network to raise the money, and in a space of a few weeks, I think they raised more than 200 billion. So it's quite sizable, and they are experimenting things, they are doing things that we haven't done in the West. So that speaks to the level of sophistication that is there now.
Let's talk about fee structure, because I know everyone wants to touch on this a little bit more. It has been an area that has been impacted by passive disruption. You've seen a lot of consolidation as a result. It used to be a very lucrative area for asset managers, particularly for active managers, when you talk about fee structure. What's changing, and what does the fee structure of the future look like? First up, Greg.
It should look like the same that it should have looked like for the last 20 years, which in active space is a sharing of the risk and return with the plan sponsor that the manager is earning. The question is, what's the right sharing ratio? If I go back to when I started in the business, it was somewhere between 15 and 20%. Then we saw alpha become a commoditized levered product into hedge funds, which was sold for about 30% of its return. And if you had really good alpha, you were selling it for 40 or 50%. Incredibly egregious. I think 20% is probably the right sharing ratio, and I think we're going to see industries move to get that sharing ratio back down to the 20% level from the 30 to 35% level that currently exists.
How do you feel about that?
That's fair. I think 10 to 15, 15 to 20%, maybe 25%. Is reasonable. Again, it comes back to are you providing alpha? And if you're not doing that, then you're going to be priced as a passive, and you've got to structure your business that accordingly. I think to the point of consolidation, there's been a lot of talk of it happening, and with the big mega mergers, there's been a handful of mid to upper size that have done it. You haven't seen a lot of it yet. I know there's a lot of boutiques that are for sale, and prices are attractive for them to be sellers at this point. I think the ones that are going to win, in my opinion, are going to be the ones who are doing it for the growth reasons, not the cost cutting. I mean, if you're merging two businesses together simply to cut costs, then you're just stemming the tide of what ultimately is going to get to your business. So I think the ones that will ultimately survive are those that are going to be innovative enough and thoughtful enough to go out and do acquisitions and merge, but with growth in mind. You clearly want to get some cost synergies out of it, but if that's the sole reason you're doing it, I think that's a bad long-term strategy.
I was reading a report that was saying that active managers are just handicapped by their fees. Even if they outperform, effectively all the gains are eroded by the fee structure anyway. What do you make of that?
Well, you got to look at net returns. I mean, I think we try and go out and advertise gross returns, but unfortunately, investors don't get gross returns. So you've got to provide a reasonable amount net of an index or a beta product. I mean, if you do it on a little bit of a basis, the incentive to move to active is just not going to be there, and I think that's a lot of where large cap growth and S&P things have fizzled. There just hasn't been the ability. Those who have done it, there's been very, very few who've repeated it, and the magnitude of that alpha is so small that it's not worth taking that step.
But I think there is also, a sort of cyclical element. In other words, there is a structural element, which is the passive growth of efficiency in general, which is driven by technology. But there is a cyclical element which is driven by rates. I mean, the fact that rates have gone down a lot over the last 10 years means that the returns, the expectations for returns are lower, and therefore people are pressuring fees because that's a good way to earn an extra return. But if one day we get back to levels of rates that are actually reasonable, then the pressure on fees will be structural because of the passive moves, but there will be less pressure than we see now.
Oh,
now
you think?
I hope.
I think even if indexing didn't exist, you'd still find a very competitive dynamic, I think, at the moment. So the question, it came up at the 19th Party Congress, apparently, what is the purpose of finance? It's to join savers and investors where capital's needed and to fuel the real economy in the interest of consumers. That came right from the top. And so Chinese asset management is going to change as a result of that force. But equally, we should be asking the question, what are we doing here? We're the bit in the middle. So if you have people who are not motivated and very low quality from a human capital perspective, making capital allocation decisions in the economy's going to have problems. So you have to pay a certain amount. The question is, does it get out of hand? Because people make 10, 20, 30-year career choices, and you can't easily switch, so to speak. So we may be oversupplied at the moment, I suspect, and that will result in pressure on fees going down. That oversupply plus technology is going to drive fees down.
To what level? What's your number?
I don't have a number. I mean, I knew you may ask that question, but I'm not sure I've got a number in mind. But the forces are very, very strong. Well, so is it unlike any other industry where you've got change happening, you've got introduction of technology, you've got customers who are disenchanted because they thought they were going to get something and they got something different? I don't think it's going to survive that set of pressures any better than any other industry. So we've got to retool, try harder, do better, and maybe costs do come down. I'm not talking about indexing, everything.
Yeah. Well, beta is a commodity. It's very cheap, and your organization sells beta for S&P 500 beta for less than a basis point to large institutional investors. It's almost free. I can buy a futures contract round trip for $12 these days and have $250,000 of exposure. So my ability to get exposure to the listed markets via derivatives is incredibly cheap and liquid. the beta factors, or excuse me, the factor exposure I can buy for 10 basis points in unlimited size with daily settlement, liquidity, and transparency. Alpha is what is dearest and most difficult to generate. So alpha I will continue to pay a reasonable fee for. And and for you, I'll pay it, but I'm going to charge you a high water mark. So, but we just have to think about what you're actually buying and what the benefit is to your portfolio. Alpha is scarce, it is arbitrageable, and if you can find it, then you'll pay money for it.
Maybe a cheap dinner thrown in that.
No, that's fiduciarily
days.
imprudent to accept something like that.
Michele, do you want to just get the final word on fee structure? What's the
Of
natural
course.
level, as you argue for, quality managers to be paid?
Well, of course. I mean, but also, I mean, if you look around, the best structure that we have seen is the one of the Norges Bank, so the sovereign wealth fund, where they charge very limited management fee and a very big performance fee, or they allow for people to earn a very big performance fee. That's been around for many, many years. It's been successful for them. It's worked, and it's reasonable. Now other people are trying to structure this in other ways, but in reality it's been there and it was started by a sovereign wealth fund. So I think it's reasonable, and it's been well adopted, so that's probably a standard going forward.
Okay, we've got about a minute 30 left, which is probably all this topic deserves. Bitcoin. We've been talking about it ad nauseum on our channel, and we see price rises, price falls. The banks that we speak to, the CEOs, don't want to talk about Bitcoin. They're quite clear. They want to talk about blockchain, not Bitcoin. Does anyone have a view on whether you're going to be selling these types of products in the marketplace, offering them to investors and clients, whether it's something that's going to be held in portfolios at some point?
Well, the valuation's hard to pin down, but there are some attractions to cryptocurrencies that we shouldn't ignore just because there are some bad elements to them as well. And I think the challenge is maybe one for regulators to get together and say there is a way that we might endorse cryptocurrencies, or a cryptocurrency, I'm not going to mention Bitcoin or any others, in exchange for eliminating those things that really make them troubling. Facilitation of money laundering or other illegal transactions, or the avoidance of tax. If you could get the negative elements out of the way and leave behind the attractive parts, I think that could be then more interesting. We'd still have a problem valuation-wise. What is a Bitcoin worth fundamentally is very hard to assess.
The good thing is that it's another asset class, so you can create an index for you. So you can sell another asset class. It's even better. But in general, I mean, I think it's difficult because you have to be, I mean, it's easy to be skeptical, I think, and at the same time, there is element of truths, I mean, this in the technology in particular, so clearly people are interested because of learning the technology rather than the Bitcoin itself. But everyone is trying to buy it because it's going up, so
Right.
that's the reality.
I've missed the trade personally, and we have no plans to start anything with.
You mean
with
the
Bitcoin.
$1,000
Yeah.
to 10?
All of it, from
Right.
0 to 11,000, the whole thing. I think that, and I'll revert back to what everyone else wants to talk about, the blockchain technology. I think that's where it is.
Safer territory.
It's easier to pinpoint, and that's probably where we'll leave it for us.
Greg?
Bitcoin, big disaster, a bad idea. You know, you're not going to win either way. And in the current structured environment, I think Rick is correct. If you could eliminate the lack of transparency and the benefit of this cryptocurrency being used for illegal transactions, then it could be possibly utilized. But there's still the issue of whether it's backed by any faith and credit. And then I think governments have a problem in that typically a currency is backed by debt. And a Bitcoin is not, or a cryptocurrency is not backed by any debt. So by nature, it's a deflationary asset. And if you transition to a Bitcoin or a cryptocurrency-based economy, you have to deal with a deflationary asset in a very large scale. And I don't think the central banks are ready to deal with that at the current time.
We'll leave it on that note as we talk about inflation constantly and chasing it. But I can't help but think in a year's time we might be talking about Bitcoin more with 3 exchanges looking to offer Bitcoin futures. We are going to open up the conversation to the floor. We have a couple of microphones moving around, so just put your hand up. A couple of questions down the front here if we want to bring the microphone down. Please say your name, and if you have a panelist in particular you want to direct the question to, please do so, or generally we can get someone to respond.
Regarding the hot topic of fees, Allborn Partners, one of the largest consultants, is pushing the 1 in 30 model for managers. So just curious if you think that's a viable model.
1 basis point and 30 basis points,
basis
yes.
point.
I think that's a very viable model. 1 in 30 is ridiculous. That works out to 40% of the alpha for an active manager fee. That's twice what the industry should be
I
paying.
think it's 1 or 30.
Oh, the one, it's 0 and 30. So the Alborn model with Utimco is 0 and 30. 0 fixed and 30% of the profit. 0 and 20 is fine for me, but 0 and 30 is still too expensive.
Rick?
I mean, it's odd. How do you model that? I mean, if it was minus 10 and 30, what would you think about? I'm paying a little bit of money to get access to capital to make 30% of the profit. I mean, I could make an argument that's not a bad model either, actually. I think the question is, what risk controls do you put around that process to stop yourself being a volatility trader?
We'll take another question. Thank you.
Hi, Greg. My question is to you on AI, basically. When you go and invest in an AI fund, first of all, a true AI is something that humans can't do, don't understand, and can't explain. How do you do your due diligence on them? And if something goes wrong in the future, how will you explain it to regulators what went on?
Yeah, that's a great question. By definition, if you're investing in a pure AI fund, you're not defining up front what your confidence intervals are or how the decision was made. So if it's not successful, you take on a fiduciary responsibility by saying that, yes, I invested in something I thought would work and it didn't. So you can go through a due diligence process. You look at the quality of the people involved. You make sure that the algorithm that they've used to establish the AI as an effective one, you look at the testing that was done and make sure that it was out of sample testing. And then you review on an ongoing basis. The other thing that we do if we're looking at AI, we think AI can add value, is we're going to hedge the expected return. So we'll buy some downside protection in case the AI model is wrong. That's the real problem with AI, though. I don't know what's driving the return. So when I'm building an aggregate portfolio, I don't know what the marginal contribution to my aggregate portfolio risk and return is of that AI strategy. But if I think it's effective or it has optionality characteristics that I like and it can produce an excess rate of return, I'll use some of that excess return to buy downside protection in case I'm wrong.
I've got another question down the back.
Thank you. Jared Carney, Lightdale. To the question about the point that was made earlier about publics and privates and the markets crossing over, if not converging, can you speak in detail how you see that playing out in tech in particular, and whether you see right now, today, any ability to create and participate in whatever liquidity is being created for private tech stocks?
The equity's outside my rig. Rick, you want to?
Michele?
Well, I think the technology space is very interesting in that respect, because if you go to Silicon Valley, then you realize that actually the network is very important for people. So the VC that are doing the best deals are the ones that are better connected and can get the deals before everyone else. So despite of the fact that it's technology, actually the human element is very important in getting these deals first and getting access to these deals. I mean, what surprised me is that if you look at VC, it's not necessarily the investors trying to give the money to the companies, but it's the investors trying to get the meeting with the CEO or with the hottest startup and so on. So the relationship is inverted completely, and that means that you have to be with the best people, and there is probably 3-4 firms that are leading in that space. Therefore, that means that if you are in those type of companies and in those VC funds, you will do very well. Otherwise, you have to wait for the public markets, because frankly, in the middle, it's very difficult. For the standard VC company that is not well connected, it's very difficult. And I think this is probably true in other industries.
Is it just title? I mean, I remember a couple of years ago speaking to the head of the NASDAQ, and there were just simply not technology companies coming to the market. There's a real problem in the pipeline because of the valuations around some of the raisings that had happened, I think around secondary raisings. So this impacted then whether the companies were willing to IPO because the valuation simply didn't stack up. So we're still seeing a legacy impact of that, which once it's cleared out, you will see tech companies return to market.
Well, I think if capital is available in the private market, they're going to prefer to stay private in most cases. It gives you more of an element of control. It's probably more efficient to operate that way. Your owners are aligned for a certain period. So I think as long as there's sufficient capital in the private market, more and more of these companies will stay and wait until they think they've reached maximum valuation and then look to turn it over.
Either when they reach maximum valuation, or they become essentially a company that's whose growth prospects are based on GDP growth, so that they at the margin can't add a lot, subject to the potential benefit of not being a regulated public company, can reach a lot of excess growth. At that point in time, they will become public companies. But to the extent that they can continue to grow in a private environment, and they have capital provided by the private markets to allow for their capital formation, then they're going to stay private.
We're going to have to leave the conversation there, unfortunately. Thank you so much for participating in questions. Please thank our panel, Greg, Rick, Michele, and Michael. Thank you very much.